Hello, I'm Bill Blain, strategist at Shard Capital. So welcome once more to my office. Once again, I'm going to try and explain what's actually happening in markets. Now, it's no secret that markets have become incredibly complex. There's a host of competing short, medium and long-term dynamics underway, and they're happening faster with greater impact than many of us have the capacity to understand. Try and think about it and you'll see how confusing it is. And the speed of the change is skipping us by, numbing us to many of the changes going on around us and how quickly it's happening. So trying to explain the contradictory bluster of market dynamics is an almost impossible task in the sort of 10 to 15 minutes I'm going to waste your time with, but let me give it a go. It's all about understanding the reality. So let's start with the virus, the pandemic. It doesn't actually matter how serious or not COVID-19 has actually been. The effect has been to shock global economies. The pandemic details are the things that are moving markets in the short term, but they're also setting the narrative for the future. The effect of every new lockdown or vaccine news or government failures on testing, these are the things that are impacting markets every day. The longer lasting effect on company plans and government spending will ultimately depend where the global economy goes. Now, the reality, even after a cure, the pandemic will remain a historical shock that's roiled short-term markets and is going to set a multiple series of long-term agendas. Stop denying it's happening and get used to it. Second thing I want to talk about is bubbles and values, and I'm rather chuffed that I called the top of the Tesla bubble last week. It's an example of a speculative bubble burst that's underway. Investors have always wanted to believe in exceptional story stocks, and they never want to miss out on cheap new IPOs. That's been a factor of the markets since the very first time that someone swapped a bushel of corn for a nice tasty looking piglet. It's hype and fear of missing out, FOMO, that drives up expectations. That's what drives bubbles, and the last 6 months have seen the bubble vibe get to extraordinary levels. It's been fueled by low returns from markets and fears about the futures. And there's always denial that bubbles are going to burst, usually because of the false notion that this time it's somehow different. I got called a fat moron yesterday when I talked about Tesla. Apparently I don't understand. My view is that it's going to fall to about 10% of its peak value. And even though there's a logic behind what Tesla is doing, the lack of returns means it's not worth what people think it is today. Bubbles inevitably lead to mean reversion. The reality is, bubbles are inevitable in markets. You have to learn to ignore them. Value, on the other hand, lies in cheap and underpriced assets. And that's where the recovery is going to get the greatest returns. Cheap assets are where the opportunity is. Now let's step back and just think about the global economy. Whatever the optimists say about the apparent strength and speed of recovery from the pandemic shutdown, there are going to be long-lasting negative effects. We all know that. Growth is returning and many jobs lost or furloughed are reopening. Yet, sectors like tourism, hospitality and aerospace remain shuttered, so that's going to drag down any economy reliant on them. There has been repressed consumer spending in recent weeks, but equally, fear about jobs is holding consumers back. The reality? Nobody's talking about a V-shaped recovery anymore. We now know how complex it is. The real economy is taking a massive knock, and it could take years to play out, even if GDP recovers quickly. And as the economy recovers, it's going to adapt. I think we'll see 90 to 95% recovery quickly, but the last 5 to 10% proving sticky as the economy struggles to adapt. Now let's just talk about stock markets for a moment, because as we've seen over the last week, there has been a correction, and I think it's going to inject some common sense back into markets. There'll be a shift away from the bubbles and into fundamentals, producing decent profits and a decent outlook. After a corrective phase, stocks are going to return to elevated levels. Why? Because we've got ongoing central bank QE infinity, and that raises the relative value of stocks when bond yields are so low. But also because if we do see inflation, it makes more sense to own good equity assets rather than debt. The reality is that confidence remains nervous in the wake of the disconnect we saw last week and ongoing economic weakness, but volatility remains relatively low. My guess is that stocks are going to continue looking a better bet than bonds. But let's then move on and talk about bonds and start off with corporate debt. There is a curious belief that the investment banks are selling that corporate debt is a great thing in this recessionary market because of government support, the stimulus packages, and QE infinity guaranteeing liquidity. But returns are close to zero. What happens if inflation comes back? That's your problem if you hold debt. The reality is that burgeoning corporate debt is a threat. The longer the pandemic continues to ravage company balance sheets, there'll be mounting solvency risks, delayed investments, and zombie companies will not get wiped out. And that's a key thing in a capitalist economy, creative destruction as companies become ineffective. The reality here is that solvent and barely solvent companies are issuing record amounts of debt at ultra low rates because A, they can, B, lots of investors have mandates that require them to buy them, and C, corporates see the upside of inflation inflating away the debts that they take on board today. None of these are good reasons to buy. The risks are stagnation or deflation. I don't see much upside there. Let's move on and talk about sovereign debt, the other form of debt you can buy in the market. Now, I'm very, very concerned that we're going to see a problem here because people are fearful of burgeoning debt. But look, any company that owns its own printing presses has monetary sovereignty. It can print as much money as it wants. Now, that only goes wrong if you get a breakdown in confidence and you get inflation. And that's the thing that could be the issue for modern monetary theory, MMT. Countries that don't have monetary sovereignty, and that includes the whole of the Eurozone, are going to struggle to finance recovery and may be forced to adopt austerity. Dollarized emerging market economies are going to struggle because they don't own the currency. However, there is an interesting reality here. This could be great for Europe because what we've seen with the 750 billion recovery plan is effectively fiscal union. And that's great if it allows Spain, Italy, and the rest to reflate their economies, triggering growth across Europe. It's a big risk, though. It's a political risk. Will Europe accept that it's been unified by debt? And this is where we have to start discussing the difficult stuff. And fiat currency is something that people have always struggled to understand. Fiat currency is basically a currency backed by a promise to repay. The question here is how much money can governments create? MMT suggests they can go and create lots. One strand says that helicopter money, in other words, giving money directly to consumers so they drive consumption, will help the economy grow. However, a better question might be, how much money can governments create and still get away with it? At what point does confidence break? Will too much debt issued by less than competent governments cause a crisis in the FX market which would trigger inflation? Will unlimited government helicopter money simply trigger consumer inflation? This is all terribly interesting stuff, and the reality is that there are still questions about MMT. It's a cosmetically attractive option, which is why we should be wary. However, the alternative to MMT, which is sovereigns spending their way out of the crisis, is worse. Austerity is going to create a massive, much longer lasting recession. And this is where we come to gold. Gold is not fiat currency, it's something far better. Always believe in gold. It's not just an inflation hedge, it's a hedge against MMT as well. Interesting thought is my Italian job thesis. 4 million of gold in 1968 is worth 411 million today. Gold is a real asset, and the reality is it's now a core part of my own investment portfolio. But now we have to talk about what all these factors in the market do to society. And society is the thing that is changing fastest. This is real political economics, the basis of economics. And politics is a very powerful force in markets. Look at last year when markets took great relief that the UK rejected Corbynism. And everyone agrees that Bernie Sanders would not have been a terribly great president. Now the Republicans in the US are trying to scare voters that President Biden, if he wins the election, will cause a massive collapse in the markets. That's the way markets have always reacted to politics. But listen and look at what's happening in politics and consider the society changes that we're seeing. These are happening very quickly. There's a growing sense of deja vu all over again. It's happened before because it has. For the last 12 years, it's been big companies, the banks, senior managers and the owners that have reaped the rewards of central banks juicing the markets through QE. Shareholders have been bailed out while losses have been socialized across the whole of society. The more middle class a job, the easier it's been to work from home and avoid furlough. But that's changing because now it's manual workers who are seeing their jobs returned, while the many office workers still in furlough are likely to learn what an unemployment office looks like very shortly. Inequality is rising. The reality is that over the last 12 years, all the consequences of central bank monetary experimentation is now coming due, and it's going to lead to massive social changes that markets have been blind to in terms of sorting out rising income inequality and social injustice. Look at what the noise has been about this year. A battle is coming, whether it's the Black Lives Matter movement or wealth inequality. Markets tend to hide behind the claim that private enterprise is always better than government. Markets love that shareholder economy dictum, Milton Friedman saying that the only duty of a company is to maximize shareholder returns. However, the last 30 years has demonstrated that corporates aren't so great. Just take a look at Boeing and look at the number of billionaires in a world that still can't eradicate poverty. There's a crying need for change, which is why we're seeing politics move towards stakeholder capitalism, workers and consumers sharing with the owners and the management the fruits of their combined labour and the spending that they do to make the markets and put the economy a better place. That's where politics are trending. In many ways, stakeholder capitalism is the same as institutions focusing on ESG, the big thing in markets, environmental, social and governance. There's a shift going on in what governments can achieve, and it's not being addressed yet by the lethargic politics. Although I do suspect that Boris Johnson's government will stumble into it at some point. The reality is the world is changing. Politics is going to demand a shift from wealth creation in the private sector. And that's not necessarily a bad thing in terms of health, education and welfare provision. And it may mean a vastly increased role for infrastructure finance. But at the end of the day, it all depends on government debt and whether we can continue to bail out the economy with massive amounts of sovereign debt financing it. And that's really a question about modern monetary theory. The only conclusion I can offer is that the next few years, months, even days, maybe weeks, are going to be extremely interesting. And you know what? I haven't even mentioned the risks of a global financial reset. I guess that means I'm fairly confident that, as usual, we'll muddle our way through. Anyway, thank you very much for your time. Look forward to speaking to you about something else next week.